Hey, how you doing? It's Clayton Teeny from the First Home Buyer Club. 100 lessons in 100 days, day 71, lesson 71. You're probably wondering how I saw you this afternoon. Yes, you did. What I want to cover off again on is taking that next step with extra repayments and mortgage reduction, because we had a lot of questions come in overnight about why are we doing it, what's the benefit, and explain a little bit more about the numbers that I spoke about. So today, all I'm going to do is focus on 3% interest rate, 400,000 over 30 years, and I'm going to break it down. Not just about paying off the home, but what effects it does on your life and how you prosper as a result of it. So I'm going to talk briefly and cover off on these things that we spoke about from the start. 400,000, 3% over 30 years. Now, you've got to think about it, especially at the moment. There's $40,000 worth of cash for your own home. And if you're eligible, you can also avoid paying mortgage insurance. So straight away, simple math, if you only contributed $10,000, you'd be purchasing a $450,000 home. Now, be aware you need 5%, right? So on $450,000, you've got to have $22,500 just to tick the first box. So we're really looking at any purchase from $460,000, $470,000 to get these numbers. Now, straight off the bat, when we think about this, right, if you're purchasing a $460,000, $470,000 home, you've got to expect to be paying somewhere in the vicinity of $450 to $470 per week in rent. And so when you see these numbers, you really start to understand why. I'm very focused on getting you to understand the numbers and what you can do with your own money. At 3%, when you divide it over the whole year, you work on just under $390 a week. It says $389.17. That's principal and interest. It's not just paying the interest of the bank, it's helping you pay it down faster. Now, the second part, what I want to talk about is the extra repayments part. Now, I'm going to talk a lot today about if you were just to contribute an extra $200 per week. So instead of paying $390, you actually contribute $590 or $600 towards your own home, which is broken down what you're currently doing in rent and savings. So if you're renting currently at the moment at $400 or $450 a week, and you're in the ability to save another $200, there's $650 per week in rent and savings as it is. We don't always look at the savings part as actually spending that money, but when you look at it as money that you contribute, rent and savings, and you combine it together, there's a lot more ways that you can see that you can pay down the home faster. Now, I'm going to talk about it again. Equity. Really, equity is gained on a few ways. You can either create equity through the value increasing. The other area that I want to focus on is actually paying down the home faster. So if you buy the house here, right, the house goes up 100 grand, theoretically you've got 100,000 in equity that you can utilize later on down the track. Now, what happens over the next 10 or 20 years, you pay off the home faster and you save 100 grand in interest. Now, not only do you have the 100,000 in equity, you've got 100,000 you've saved in interest repayments because you've dropped the mortgage down, and now you've got a bigger spread, 200,000 equity that you can utilize towards anything you want, right? So again, we're going to focus on a couple of things. The $200 per week. Why? Because that's the point I really want you to focus on. Now, I'm just going to shift to this my right-hand corner, your right-hand corner as well. And just look at this for the first point. Now, in the first 12 months of your home loan, everyone knows you pay more interest than you pay principal. It's just common sense. Everyone knows it, right? Now, it's not that at the start of the home, the bank just takes all the interest off you and you don't pay any principal. What happens is when you owe the most amount of money, you pay the most amount of interest. I always call it as a seesaw, because at the top, you owe the bigger chunk of money and it costs more as a thank you repayment to the bank. But as you start piling on the weight or the equity in the home, we start to level out the playing field, and it gets to a point where you're even Steven, 50% interest, 50% principal. And then we continue on because those same repayments each week are now paying off the home faster, and you're paying less interest repayments, and that same money is now going more towards principal. And that's where you create the big chunk of equity, right? So I'm going to keep it simple just on this one, even though we know it's $390 per week based off these numbers. Now, you know, in the first year, you pay more interest, and you actually pay 142% more interest than principal. So what that means is if your repayments were $242, and I'm only using $242 as a simple answer, $100 would go towards principal, and $142 per week would go to the bank as a thank you repayment. Because I always call interest repayments to the bank a thank you repayment, kind of like your rent. Because at the end of the day, you're just thanking the landlord for living under his roof until you get the choice to either move out or he actually asks you to move on. So when you look at that, the 242, 100 goes towards principal, 140 towards interest. Now, why do I talk about it? Because just like a coin, there's always two sides. And if you think about this, for every extra 100 you put in, you're going to save $142 in interest repayments. And just like equity in a home when the prices go up, this is $142 is money you're going to collect down the track because you won't have to give it to the bank. And so when you always think about that and you look in the first 12 months, you can nearly 2.5 times return on investment on your own home by just investing into the house. Now, everyone knows that I always suggest, and all our finance brokers we work with as well, everyone suggests put in the offset account. You can get the same benefits, but if you need to pull it out to buy a car or something else, holiday or family emergency, you've got that cash available. But when it sits in there, you save more interest. Right? All right, we're going to focus down the bottom. I'm going to talk about the numbers, and I'll try and bring it in a little bit so you can see better, but apologise because I've got all the lights, it's a bit harder. So I'm going to focus on the extra $200 a week. We know that if we can contribute $600 a week right now in rent and savings, that we're in a good ballpark. Now, yes, I know everyone's going to say you got to pay rates, water, and insurance. We always say allow at least $70 to $80 per week. However, areas change where the prices go up and down. But focus on this. We're going to look at $200 a week. Now, you think about it. How could I save another $200 a week? Well, firstly, that's only like, I don't smoke, but maybe 3 or 4 packs of smokes, maybe 3 or 4 cartons of beer. That coffee every morning there's $25. You see how we're suddenly changing all our numbers really quickly. The palmy at the pub with a few beers, there's $100 there. We're already making massive changes without changing anything. So if we look at this, an extra $200 a week, that would reduce your mortgage to 16 years and 8 months instead of 30 years, right? Not a bad result for $200 a week. Now I understand what you're saying, though. You'd be like, Clayton, that's really good. But what you're telling me to do, I've got to wait 16 years before I get the fruit for the hard work? No. Think about this. Come back to the percentages and the returns. Every time you put in 100, you're going to save 142 in the first 12 months. So when you think about that, and even at the 3%, I will look at it again just to confirm, even at the 3%, long term, you pay over the term of the mortgage, you pay back 152%. Meaning that if you borrow $400,000, you pay a little bit over $600,000 total. So if you think that every time you put in 100, you're going to save 150%. So that 100 saves $150. Not a bad result every time you put it in there. Because you got to ask yourself, if I asked you to give me $1, and then I said, if you give me that $1, I'll give you $2.50 back, would you do it? Would you also do it tomorrow and the following day? Because if you know you're getting those returns at some point, it's an easy pill to swallow, right? So we look at this. That $200 a week is going to save you $98,930 in repayments, or in interest, really, because you paid it down. But what does that mean, Clayton? Well, think about this. For you to actually save $100,000 or $98,000, you've got to earn more money, because the tax man's got to put his hand in your pocket and take out his chunk and go, hey, congratulations, working hard. Here's my share, and then here's what you left out of it. So and I've kept everything at 30% to keep it just normal, but for you to save $98,000 or $99,000, I'll keep it even, you actually, in fact, need to earn $141,328. Now, think about this. How many years' work is that to get what you can do instantly just with some small changes of habit? Well, how does that work out? No, the average family in Australia, according to Google with all the reports, says the average family earns around $90,000 a year. Now, surely Google wouldn't lie to me, but it's in relation to retirement and age pension, all the rest. So I think it's probably ballpark, right? So $141,000 of earned income works out to be somewhere around 1 year and 7 months that you need to go to work, or your family needs to go to work, before you can earn this money, which then after tax gets you this money. And that's if you don't spend $1. And we all know there's no way we can go a year and 7 months without spending $1, but let's just stay with it. Now, what is 1 year and 7 months actually to you? Well, according to the numbers, that's 2,888 hours of work with that horrible boss, with that bad traffic, with the microwave that doesn't work and the kitchen that's always dirty, just to get to this point. Now, that's a lot of hours just to make a few small changes to your lifestyle, right? So then I'm going to talk about the second point, and this is a scenario because I had a client, they're like, well, I'm 35, I'm looking at buying now. How does it work for me? So we're going to look at this, the scenario A. You're 35, you buy your first home using the $200 extra a week, and that's interest rates not going up and down. So I'm not really going to get into that argument or discussion during this session. But at 35, you buy your first home. We make these extra contributions, the offset account, and you know that by the age of 51 and 8 months, you're mortgage free. So then you go, well, what does that mean? What can I do now? Well, you can really do whatever you want, but this is what I'd like you to do. You're then going to become mortgage free, and you're going to have that cash that's just sitting around each week that you've got to invest or spend. Now, at 51 years old, I can guarantee that you probably wouldn't have made enough money most of the time. Not everyone, but enough money to live the life you probably want to live in retirement. So let's be a little bit smart with some of it and try and invest it or do something with it. You've got two options. You can invest it. You can just hard save it. So if you hard save for the next 13 years and 4 months to drag out to the 30 years, because everyone thinks that if you buy a home, you've got 30 years to pay it off, you should have in cash around 408,493 because we've used the 389 plus the extra 200, and we're just put it into an account. But what does that mean, Clayton? How does that really affect things? Well, in order to actually save $408,000 of cash, and that's if you don't spend $1, right? That's not spending $1 at all. And this is still work off 30%, but you'd actually have to earn $583,561 for then the tax man over those years to take his portion out, and then you'd be left with the ends. Now, that is a lot of money to work. And how does that work out? Well, look, still, I'm staying on the 90,000 family income, right? That means that these smart little changes we can do over the 16 years can stop you from needing to work for another 6.5 without having to do one more thing. Now, imagine that, retiring 6.5 years earlier because now you suddenly don't have a mortgage that you need to worry about, which that's pretty cool, right? But then it's like, okay, well, what do I do? Well, you've got the second option. If you don't want to just put it all in savings, the other one, you could just spend life, right? Reduce your hours, enjoy life and get through. But I would just encourage at 51 years old, be careful about that because once the money runs out, it runs out, right? It's like a well. Option 2, if you look at buying a home. Now, again, I'm keeping numbers simple. If we bought the home today at $400,000, we'd like to think in 16 years' time, it's probably going to be worth around $600,000. So then we buy the second property at $600,000. And in the space of the next 14 years, with the extra payments, because we've incorporated what we already had in our mortgage towards the second home, that you should have the second home paid off by the time you're approximately 66 and a bit years old. Now, how would that mean? Now, again, if these scenarios are right, the first home you bought at 400, 600, then both homes at the second point at 600, both worth 900 now. That would imply that you've got somewhere in the vicinity of $1.8 million in assets. Now, as life goes on, it might not be as important as big as 1.8 million now, but it's just a matter of understanding your own money and knowing where it is to go, well, what do I want in my future? And, you know, there's a lot of ways we can work out what we want in our future, but the first thing you need to ask yourself is, when you retire, what sort of lifestyle and income would you like to have? And a good way to think about it is, how much do you and your partner, wife, husband, girlfriend, boyfriend currently earn after tax each week now? And how much would you like to live on? And that's always a good start point. So if you're like, well, we earn $1,500 per week now, and that's a pretty good life. We'll go, okay, well, we need $1,500 later on to live life we want. Now, $1,500 works out to be approximately $78,000 a year. And you'd really want to be planning on at least living 20 years in retirement, because if we only plan for 5, we're going to live longer, no doubt. So when you crunch that and you're like, well, $78,000 a year for 20 years, that puts it at roughly around 1.56 million. What are you going to do to get there? Because super will only get you so far. And unfortunately, the age pension for a couple sits somewhere in the vicinity of, I think there's a little pay rise, somewhere in the vicinity of $711 or $712 a week for a couple. And unless you're comfortably living off $700 right now, we probably need to make some changes, right? So again, brings back the same point everyone keeps asking me, well, why would we do this? Why? Because if you want to retire early or more comfortably, you need to do something now for your future. Why? Because when you have more money, you can buy those things you want. The cars, the holidays, the furniture, the clothes, or more importantly, just have more time to yourself. Why? Because you're doing it for your children, and you're also doing it for the security of yourself and your family. Also the freedom and the assistance moving forward. And I guess the last thing is, why would you be smart with your money, focus on your budget, and look forward to your future? And it's because when you have more money, you get more choices. It's as simple as that. Everyone goes, money doesn't buy you happiness, which is probably correct, right? But money gives the ability to buy those things that do make you happy. And it also allows you to make choices that you can't make when you don't have the money. And so I really do encourage you as a family, because I know there is a lot of us that don't want to talk with our partners about our own money, because if you're anything like me, I grew up in a family, I didn't have much money. You know, my parents split up when I was early, and whilst I never went without food, I never went on any luxurious holidays or had any magnificent gifts that were worth a fortune. And I'm not regretting that, because my mum worked as hard as she possibly could. She worked her butt off. But where a lot of us are like that, where we didn't come from a place of money and we want to hold on to it so tightly we don't want to talk about it. But I just encourage you, especially with your partner, your family, to talk openly about money, talk about the future, talk about your goals, and talk about what you really want. Because when you know where you're going, it's a lot easier to get there than just jumping in a car, driving in a direction and hoping that you're magically going to find that place that you're looking for without actually setting a goal. So I'd encourage you, do this for you, do this for your family, do this for your children. All right, guys, thanks very much. Have a good night. Bye.